Usually when we talk about a healthy economy, there's this fundamental expectation, a baseline assumption we all just kind of accept.
Right, yeah. Like an undeniable fact of life.
Exactly. It's treated almost like like a medical heartbeat. We're told that a steady, low hum of inflation, so things getting just a little bit more expensive every single year, is the actual pulse of a thriving society.
Yeah, that's the standard textbook view.
And the opposite scenario, deflation. Prices actually falling over time. We are traditionally taught to view that as like an economic flatline, a total catastrophe.
Oh, absolutely. Deflation is widely treated as the ultimate boogeyman in macroeconomic circles. I mean, it's framed as this terrifying thing that central banks must fight at all costs.
Right.
Under the assumption that if things get cheaper, the whole economic machine will just, grind to a complete halt.
But what if that entire medical chart is being read upside down? What if the heartbeat we've been monitoring is actually an arrhythmia, and the thing we have been terrified of, things getting cheaper, is actually the central goal of human progress?
That is the big question.
Welcome to another deep dive, and a special welcome to you, the learner, for joining us today. Our mission here is to explore a paradigm-shifting argument that completely flips our fundamental understanding of money, innovation, and prices.
Yeah, we are unpacking a rather provocative piece of writing today. It's titled Number Go Down, Innovation, Capital, and Deflation from First Principles by Alan Farrington and Satya Myers.
And it is a fascinating read.
It really is. It's a profound and, frankly, a highly detailed text. The sources we're looking at take a rather relentless sledgehammer to mainstream economic theories.
They do not hold back.
No, they don't. And before we get started, it is worth noting that this material takes a very critical stance against mainstream monetary policy, fiat currency, and, central banking in general.
Right, we should be clear about that.
Yeah, just to be clear to you listening, our goal here isn't to take a political side or endorse these specific economic viewpoints. We are simply unpacking the mechanics and the arguments laid out in the original text.
Just trying to see the world through this alternative lens.
Exactly. And through that lens, they argue that true economic progress means the number on the price tag should actually go down naturally.
Okay, let's unpack this. Starting with the mainstream mindset itself. Because we constantly hear about this golden rule on the financial news, right? The 2% inflation target.
Oh, the famous 2%.
Yeah. We are told by central bankers that 2% is the magical Goldilocks number. Not too hot, not too cold. It supposedly keeps us spending and keeps the economy churning. But when you look at the actual origin of this 2% rule.
Yeah, it wasn't derived from some grand, rigorous mathematical law of nature, not even close.
Right.
The origin of the perfect 2% inflation target is, frankly, surprisingly unscientific. I mean, it actually traces back to a casual television remark.
Wait, really? A TV interview?
Yeah. Made by a New Zealand finance minister in the late 1980s. He quite literally plucked the figure out of the air during an interview, primarily just to influence the public's expectations around housing prices at the time.
That is insane, just out of the air.
That is it. There was no deep differential equation or immutable law of physics behind it. It was simply invented.
That's quite a revelation, a psychological trick that eventually morphed into global monetary policy. And this fiat mindset, it treats the entire economy like a sealed machine that can be centrally planned from a control room.
Yeah, they treat it like a predictable engine.
Central bankers look at inflation, the general rise in prices, and they tend to treat it like an act of God. They often point the finger at, greedy merchants or disrupted supply chains.
Or labor shortages.
Right, labor shortages, largely ignoring the fact that they are the ones expanding the money supply.
What's fascinating here is how this framework creates the myth of the general price level. I mean, mainstream economic models try to average out millions of different transactions into one statistical concoction.
Like the Consumer Price Index.
Exactly, the CPI. They use it to manage the economy. But there is a brilliant quote in the source material from the Nobel Prize-winning physicist Murray Gell-Mann. He said, think how hard physics would be if particles could think.
I love that quote. Because human beings aren't gas particles bouncing around in a pressurized chamber.
No, they have agency.
Exactly. Trying to average the price of a haircut in New York and a ton of steel in Ohio to somehow centrally manage an economy, it feels like trying to measure the average length of a piece of string.
Right. It's a nonsensical metric.
It's fundamentally meaningless. How can a central committee possibly plan for billions of subjective, emotional, and highly situational human decisions happening in real time?
Well, the underlying argument of the text is that they simply cannot. Entrepreneurs do not act on the rigid rationality of a macroeconomic computer model.
They act on reality.
Right. They act on intuition, localized knowledge, market signals. They take risks to find more efficient ways to marshal resources. And when they succeed, they offer the consumer more value for less money.
Which is the very definition of innovation.
Exactly. But because the current system is so obsessed with maintaining this fabricated inflation target, to incentivize spending, there is an absolute terror of prices falling.
Which naturally brings us to their ultimate boogeyman, right? Deflation.
Mm.
And there's a really crucial distinction made here that changes how we view falling prices.
Yeah, a vital distinction.
The argument is that mainstream economics dangerously conflates two entirely different types of deflation. There's bad deflation and there's good deflation.
Exactly. And this conflation is where the diagnosis goes completely wrong. Let's look at bad deflation first.
Okay.
Bad deflation is the chaotic result of a credit unwind. Imagine a massive artificial credit bubble popping. Defaults rise, the lending binge abruptly ends, and everyone suddenly scrambles for liquidity to cover their debts.
Like a bank run scenario.
Right. In that environment of absolute panic, prices crash. But the falling prices are just a symptom of institutional failure and massive balance sheet stress. The root problem was the fragile, debt-fueled bubble that popped.
Right. But the authorities look at that wreckage and conclude, look, falling prices caused all this pain. We have to prevent prices from falling at all costs.
Precisely. They see the symptom and declare it the disease. They miss the possibility that their own monetary expansion created the fragile misallocation of capital in the first place.
Yeah, it makes so much sense.
Now, contrast that chaotic unwind with good deflation. Good deflation is an endogenous process, meaning it originates from within the system itself, driven by human progress.
So it's a positive force.
Very positive. It is what happens when entrepreneurs risk capital, innovate, and find ways to produce more or better output with the exact same inputs. It's the steady, productive mastery of nature. It turns rare luxuries into common necessities.
Wow. If we apply the analogy of the hangover from the text, the way interventionist mainstream economists react to, the Keynesians who believe in actively managing demand, the way they react to a credit crunch is quite telling.
No, the hangover analogy is perfect.
It's like looking at a massive, painful hangover, deciding that the state of sobriety must be the root cause of the headache, and concluding the only possible cure is to just start drinking again immediately.
Just pour another drink.
Right. They prescribe injecting more liquidity to fix a crisis that was originally fueled by excess liquidity.
And it creates a relentless cycle. Because the models struggle to distinguish between the bad deflation of a credit collapse and the good deflation of technological progress, the conclusion becomes that economic progress itself, things getting cheaper, is a systemic danger.
It's crazy when you frame it that way.
They assume that if prices fall, the engine of the economy will stall because consumers will just, stop participating.
So if good deflation is just the natural result of entrepreneurs getting better at their jobs and making things more efficient, how does that actually work mechanically?
Right, in the real world.
Yeah, how are prices actually discovered out there, outside of a textbook?
This is where we have to look closely at the concept of returns. Mainstream economic models often exist in this hypothetical frozen state called general equilibrium.
It's very academic.
It is. In this theoretical state, everything is perfectly balanced and time essentially doesn't exist. But in reality, all economic activity happens through time. An entrepreneur doesn't just want to make a static profit.
Because profit is just a raw number on a ledger.
Exactly. Entrepreneurs seek returns.
And the distinction between profit and returns is very specific here, right? It's not just about making money. A return is the profit per unit of committed capital measured per unit of time.
Yes.
Time is the critical dimension that changes the math completely.
Yes. Time is everything. You spend cash today in the highly uncertain hope that cash flows will return to you at a later date. You're taking liquid potential money and crystallizing it into a specific, solid, productive asset.
Hoping it yields a positive result.
Right.
Here's where it gets really interesting. Think about money as an economic stem cell.
I love that concept.
Yeah, liquid money is pure, undifferentiated potential. It can become anything. Yeah. When an entrepreneur invests, they're essentially taking that stem cell and freezing it into an organ, like building a new manufacturing facility or funding 10 years of research for a new drug.
Right. They lock it up.
But the entrepreneur's true goal isn't just to build the factory. Their goal is to get their value back onto the liquid money network as fast as possible.
Yes.
Doesn't that natural desire to quickly unfreeze their capital Force them to lower prices to speed up the sales cycle.
That is exactly the driving mechanism. To maximize their returns over time, producers are in a state of constant tension. If they price their new product too high, the inventory just sits there.
Right, gathering dust.
Exactly. The capital remains frozen as a physical widget on a warehouse shelf instead of turning back into liquid money. So, to move that inventory faster, increase their volume, and recycle that capital into the next venture, they are naturally incentivized to lower their prices.
There's a fantastic historical case study used in the text involving the economist Thomas Sowell and the A&P supermarket chain in the 1920s. It perfectly illustrates this mechanism.
It really does. In the 1920s, the management of the A&P grocery chain made a highly deliberate, conscious decision to slash their profit margins. They cut their margin down to just a single penny of clear profit on each dollar of sales.
Which, to a static economist looking purely at profit margin, sounds absurd.
Totally absurd. Why intentionally lower your profit per item?
Right, you're making less money on every single can of soup you sell. Seems completely counterintuitive.
But by offering those remarkably low prices, they attracted a massive influx of customers. That physical inventory started turning over incredibly fast, nearly 30 times a year.
Wow, 30 times.
So that single penny of profit on a dollar came back to the store to be reinvested and reused over and over again. Over the course of a 12-month period, that one penny effectively became a quarter on the dollar.
That's incredible.
Their return on investment absolutely soared. They became incredibly wealthy, all while making food vastly cheaper for the everyday consumer.
They dominated the market by innovating on volume and time. They provided more for less.
Yeah.
But this brings us to the massive roadblock that mainstream economics always throws up, the infamous paradox of thrift.
Ah, yes. The great fear.
Fear goes like this. If prices are constantly falling because entrepreneurs are getting faster and more efficient, won't you, the consumer, just stop buying things?
Right.
Won't you just hoard your money under a mattress, indefinitely waiting for things to get even cheaper tomorrow, until spending dries up and the whole economy collapses?
That is the ultimate fear of a deflationary environment, yes. The belief that saving is essentially a terminal disease for an economy.
But examining human nature and historical reality kind of dismantles this paradox, doesn't it?
Completely. First, we have to talk about time preference, which is an economic term for how much you value receiving something today versus receiving it in the future. Nobody's time preference is zero. You cannot only produce and never consume.
Right. If you are hungry today, you are not going to wait an entire year to buy a loaf of bread just because it will be 2% cheaper next year. You would starve.
Exactly. Human biological needs dictate that we have to consume essentials in the present. But what about non-essentials? What about technology or luxury goods? Things we don't need to survive.
That is where the historical mechanics of Moore's law and Wright's law come into play. Moore's law is the observation that the price of computing power roughly halves every 18 to 24 months.
Crazy fast.
It is arguably the most aggressive deflationary curve in modern human history. Now, if the paradox of thrift were a fundamental truth, if people truly delayed consumption indefinitely just because something will be cheaper later, no one in 1970 would have ever purchased a computer.
Right. They just keep waiting.
They would still be sitting around today waiting for the ultimate bargain. Because next year's computer will undoubtedly be twice as fast for half the price. But that's entirely the opposite of what actually happened. People bought computers aggressively, adopting them into every facet of life.
Exactly.
And this touches on Jevons paradox, right? Which states that as a resource or technology gets cheaper and more efficient, new, previously unviable uses for it become profitable.
Yes, so total demand actually rises.
Right. The resource gets cheaper per unit, but society as a whole ends up spending more on it, not less.
Which completely negates the assumption that lower prices automatically destroy demand. Look at the mechanism behind Henry Ford's success. He relentlessly improved his assembly line to cut the price of the Model T.
Did consumers stop buying cars waiting for the price to hit zero?
No. As the price collapsed, the number of units produced and sold skyrocketed. He didn't shrink his revenue. He enlarged the entire market by making the automobile accessible.
There is also a brilliant anecdote detailed in the text from the famous investor Charlie Munger regarding his early days in the textile business. It perfectly illustrates the brutal reality of competitive innovation.
That's a great story.
Yeah, someone came to Munger with a brand new loom technology that did twice the work of the old machines. And Munger reportedly said, "Gee, I hope this doesn't work because if it does, I'm going to close the mill."
Munger understood the precise mechanism of good deflation. I mean, a static thinker would assume that a machine doubling production would simply double the factory owner's profits.
Sure, double the output, double the money.
But Munger knew that under competitive market pressure, his rivals would also buy that new loom. To win market share, competitors would lower the price of their fabric.
So the price of cloth drops across the board.
Very quickly, the cost savings generated by that technological innovation would inevitably have to be passed entirely to the buyers of the textiles. The innovation made society richer by making cloth significantly cheaper, but the factory owner had to keep investing and running faster just to maintain their existing profit margins.
Wow. But let's explore a hypothetical scenario for a moment.
Hmm.
Even if society did suddenly become incredibly thrifty, let's say everyone radically shifts their time preference, delays all non-essential luxury spending, and decides to just save their money.
Okay.
The argument in the text is that this isn't actually a bad thing. Doesn't that just mean people are deliberately elongating the holding period of their money?
Yes.
And by doing so, aren't they just signaling to the market that they prefer future goods over present goods? How is rewarding people for delaying gratification and backing the monetary network a systemic risk?
Well, this raises an important question about the role of savings. If your money is fundamentally sound, saving isn't a risk at all. By holding money instead of spending it, you are essentially storing the economic value of your past labor in the system.
Right.
You are providing depth, stability, and liquidity to the network, which actually empowers entrepreneurs to take risks and figure out how to make future goods cheaper.
That's a huge mindset shift.
It is. A worker whose savings sit securely on a hard monetary system is quietly underwriting future innovation, and they are rewarded for that deferred consumption with increased purchasing power over time.
But in our current inflationary system,
In an inflationary system, this behavior is heavily penalized because the goal is to force people to spend frantically just to outrun the melting ice cube of their currency's value.
so what does this all mean for us today? History shows us that good deflation, driven by innovation, naturally creates abundance. It raises everyone's purchasing power by lowering the cost of living. So the obvious question you, the listener, might have right now is, if technology is advancing faster than ever, why don't we feel that abundance?
That is the trillion-dollar question.
Why does it feel like everyone is sprinting on a treadmill just to afford basic groceries and housing? And the argument presented is that since 1971, the monetary system has been distorting these natural price signals.
Yeah, if we connect this to the bigger picture, we have to examine the Cantillon effect and the subsequent financialization of the economy.
The Cantillon effect.
Yes, it describes the specific mechanism of how new money enters an economy. When central banks expand the money supply, it doesn't magically appear in everyone's bank account simultaneously.
We don't all just wake up with 10% more cash.
Exactly. It enters through specific, concentrated channels, usually major financial institutions and government entities.
The entities closest to the monetary spigot.
Exactly. Let's walk through how this works. A major bank receives newly minted reserves at an incredibly low interest rate. They use that fresh money to purchase assets, real estate, equities, corporate bonds at today's current prices.
Yeah.
This influx of capital naturally drives the prices of those assets up. By the time that newly created money trickles its way through the economy and finally reaches an everyday mechanic in the form of a, let's say, 3% annual wage increase,
It's too late.
the cost of housing and basic goods has already surged by 10 or 20%. It is a hidden structural redistribution of wealth. It mathematically bleeds purchasing power from the working class and transfers it to those closest to the creation of the money.
The historical data highlighted in the sources really paints a stark picture of this shift. They look at the composition of the U.S. stock market over the long term. Prior to 1971, the industries that dominated the market were the ones physically driving prices down through tangible innovation. Heavy manufacturing, steel, chemicals, automobiles.
The real physical economy.
Right. But post-1971, after the last tether to a gold standard was severed and the current fiat system fully took over, the underlying incentives changed. You see the financial sector absolutely explode in size and dominance, while the productive manufacturing industries shrink as a percentage of the overall market.
It's a massive structural shift.
So if an industry like steel, shrinking as a percentage of the market is actually a sign of success because steel got incredibly cheap, abundant, and efficient to produce, doesn't the massive explosion of the financial sector post-1971 imply that finance isn't actually producing new, tangible value?
That's the argument.
Is it possible that the sprawling financial sector is just an ever-growing army we are forced to hire to protect our wealth from a depreciating currency?
That is precisely the conclusion drawn by the authors. An inflationary environment systematically breaks natural price signals. It tricks producers into investing in false demand.
Because the money itself is lying to them.
Yes. When the currency is constantly losing its value, you cannot simply save the fruits of your labor in a bank account. You are mathematically forced to become a speculator just to tread water.
Wow.
Immense human capital and energy are diverted away from tangible engineering and physical innovation and poured instead into complex financial gymnastics purely to preserve purchasing power.
They use Argentina as the extreme logical endpoint of this mechanical breakdown. In an environment of severe inflation, factory owners in Argentina literally hoard items like motorcycle parts and raw construction materials in massive warehouses.
Yeah, physical objects.
They aren't hoarding them because they have an immediate need to build motorcycles today, but purely as a defense mechanism. Holding physical pesos is financial suicide, so they are forced to stockpile physical junk as a makeshift savings account.
It's wild.
That is not efficient, productive capital allocation. It's desperate self-defense.
And that perfectly illustrates what inflationary policy does to the entrepreneurial process. It transforms productive builders into reluctant speculators on the currency itself. It fuels these massive artificial credit booms, where producers are tricked into thinking there is genuine organic demand for their products. But the savings backing that boom are an illusion conjured by the expansion of the money supply.
The stem cell was fake.
Exactly. When the inevitable bust occurs, it isn't because consumers stubbornly decided to stop spending. It's the painful, mechanical revelation that the investments were based on distorted price signals.
This has been a deeply analytical journey through some very dense, challenging material. To distill the core takeaway from this exploration, within this framework, deflation is not the enemy of economic progress.
Not at all.
Deflation doesn't prevent investment. Rather, deflation is the absolute proof that an investment has succeeded. When an entrepreneur finds a better, faster, or cheaper way to do something, the number on the price tag should naturally go down.
A sound monetary system doesn't promise a flawless utopia. I mean, human beings will still make miscalculations, businesses will still fail, and economic cycles will still exist. But a hard money system ensures that the value of your stored labor, your savings, isn't steadily bled dry by artificial expansion of the currency. It forces economic errors to surface and correct quickly, rather than hiding them behind a growing wall of systemic debt.
It brings reality back into focus.
It allows the undeniable truth of human ingenuity and technological progress to express itself clearly and mathematically as falling prices. When the number goes down, your individual purchasing power goes up.
It's framed as the natural dividend of human competence, which leaves us with a final provocative thought for you to ponder. We've spent this time discussing the cold mechanics of prices and central banking, but think about the broader cultural impact.
Yeah, the sociological side of it.
Right. If we actually lived under a monetary system that naturally drove down the cost of living, over time, a system that fundamentally rewarded saving and patience instead of frantic, panic-driven consumption, how would that alter the fabric of our society?
It would change everything.
Would a deflationary world naturally cure our modern obsession with disposable fast fashion and relentless consumerism? If your money gained value tomorrow, would we naturally shift our societal values toward durability, toward stronger communities, and toward actually having the free time to enjoy the things we choose to buy?
This raises an essential question about what a society truly values when its money stops losing value.
Something to mull over next time you hear someone discussing the economic heartbeat on the evening news. Thank you for joining us on this deep dive. Keep questioning the consensus, keep exploring the mechanics behind the headlines, and we'll see you next time.